Hello, everyone, and thank you for joining us. My name is Jen Fries. I am the Community Engagement Manager for the Harvard University Employees Credit Union. I'll be the moderator for today's webinar, which is on educational loan repayment. I'm going to be joined by Kimberly Smith of Mass General Brigham's Employee Assistance Program Office and Mel Martinez and Rafaela Dowie of our Educational Loan Department at the Credit Union. For those who may not be familiar, we are the Harvard University Employees Credit Union. We are a not-for-profit financial institution. We were founded and are operated by Harvard employees. Most of our audience today is from Mass General Brigham, and all MGB employees and your families are eligible to join the credit union, along with anyone else who works or studies at Harvard or any of the teaching hospitals. I also attended the Harvard Kennedy School for my graduate school. I spent about 12 years paying off my student loans, so this is a personal topic for me. I remember that feeling when I sent in the last payment and how good that felt. We do want to warn you that policy on student loans is evolving quickly, as I'm sure we have all seen in the news. And we encourage you to keep up to date on the news around student loan policy from the federal government. We're going to give you some resources too for near the end for individual counseling. And as we go along, we'll put resources for you in the chat. Today's webinar, just to let you know, you are not on screen. So participants, feel free to eat your lunch, do what you need to do. This is in a webinar setting, so we can't see you. Just to let me know that you can hear me, if you don't mind taking a moment and popping into the chat, into the Q&A rather feature where you're from, then I will know that you're here and can hear me, and we'd love to know where people are joining from, if you're able to do that. Okay, great. I see some of my first ones coming in. Great. We have attendees from Malden, MGH. Great. People can hear me. Um, so um, when you have a question during this webinar, you're going to use this Q&A feature, and that's a great way. Oh, from New Hampshire, Wolfboro. Hi, glad you made it. So just you continue to use the Q&A if you have questions during this webinar, and we will get to them. This presentation is being recorded, and it's going to be posted on our YouTube channel. Our YouTube handle is myhuecu, and you will get that link sent to you as an email afterwards, so you can always go back and rewatch it. At the end, we're going to ask you to fill out a workshop survey if you're able to do so. Oh, someone joining from Nantucket. Nice. Nantucket Cottage Hospital. Why does that sound so cute? Okay. All right, so for the next slide, I'm going to turn it over to Kimberly Smith from the Mass General Brigham Employee Assistance Program.
Okay, let's see here. So I want to thank both Jen, Rafaela, and Mel for having us. The EAP is a free and confidential service for all employees of Mass General Brigham, including your family members who live with you over the age of 18. So if anyone in your household needs help or support with any of the services that we provide, we'd be happy to help connect them. We can make appointments via the phone, Zoom, or most of all of our entities have an in-person option. So if you're interested in seeing one of our clinicians in person, we do have that. And I'm not sure, I can't see the slide, but I'm hoping that it's up for everyone and they can see all of the things that we do. We have a really wonderful website that was redone in the last year or so. Here we go. Thank you. And So that is a really great place to start and look at our resources. You can make an appointment there. You can also just give us a call and do it that way, the old fashioned way. You might have heard about Employee Assistance Program when you started, maybe new employee orientation, or maybe you've seen us at one of the workplace seminars. And so that's just kind of what we do. And so if you have any questions, feel free to reach out, put it in the chat. I'm going to hang out until the end. And thanks again.
Thanks for letting me know, Kimberly, that you could not see the slides. That is very helpful. So now we are going to hear from Rafaela Dowie. She is from our Educational Lending Department here at the Credit Union. So Rafaela, could you take it away? Oh, I'm sorry. Uh, Actually, first, I'm going to tell you a little bit more about the credit union. As I mentioned, we are a not-for-profit. That means that we put our members first. We often have better rates, and we try to provide a comprehensive package of services. And we are also very invested in the community, and we volunteer in the community as well at some of the hospitals and other places. And we do charitable giving, and we have a scholarship that's going on right now as well. Um, Now I'd like to turn it over to Rafaela Dowie from our Educational Lending Department.
Thanks, Jen. Hi, everyone. Thanks for joining our webinar today. My name is Rafaela Dowie. I'm the Education Lending Origination Supervisor at the Harvard University Employees Credit Union. During today's session, we'll walk you through the steps to take to pay off your student loans. We'll start with helping you first understand the types of loans that are available and the differences between them so you understand how they work. Next, we'll cover the repayment options that are available and how those work. We'll also cover information related to federal student loan forgiveness and discharge, which are available in certain situations. And finally, we'll discuss student loan refinancing and explain how refinancing works and help you decide if that may be an option that you should consider. Next slide, please. Thanks. So we'll go ahead and get started by explaining the different types of student loans that are available, so you understand, or you have a better understanding of how each of these loans work, and you understand how to pay them off. Next slide, please. Thank you. Okay, so there are three types of student loans. We have federal, state, and private. A federal student loan is a loan provided by the United States government to eligible students or their parents and guardians to help cover the cost of higher education. Since these funds are distributed directly from the government, they are dependable or a dependable option for financing your education. These loans include direct subsidized and unsubsidized loans, and also direct plus loans. There are two types of plus loans, the Parent Plus loan and the Grad Plus loan. The FAFSA is required for these loans since they are federal loans. They are federal loans and they offer different benefits than private student loans. So because of this, it's important that you explore these options first. For state loan programs, they can provide a supplemental funding for eligible residents to reduce educational costs. These loans generally have similar terms and requirements to federal direct loans, and they are available through government agencies of your particular state. Programs can vary from state to state, so it's important to consult your state's Department of Post-Secondary Education for details about these types of student loans and what's available to you. Some states only require the FAFSA to apply for a state loan. Others require families to complete a separate application that is for their state specifically. An example of a loan offered to Massachusetts residents includes the Massachusetts no interest loan, and the eligibility amounts for this loan vary and are based on financial need. Finally, we have private student loans. Private loans are non-federal loans made by a lender such as a bank, credit union, state agency, or school. These loans can help to cover the gap between your cost of attendance and any financial aid you're receiving. And the terms and conditions are set by the specific lender. So these loans can be different from lender to lender. Next slide, please. Okay, so we'll start with federal direct sub and unsubsidized loans. You may see direct loans referred to as Stafford loans, and they were formerly, direct loans were formerly known as Stafford loans. The student is the primary borrower for these loans, and there is no credit check required to borrow. Payments are deferred on these loans while the student is enrolled at least at half time and during the grace period. Grace period on federal loans is a 6-month period where no payments are required after the student graduates, separates, or drops below half-time enrollment. I think there's a couple more, click a couple more options on that slide, Jen. Thank you. So the grace period on federal loans is a 6-month period where no payments are required after the student graduates, separates, or drops below half-time enrollment. Interest rates for these loans are based on the loan rate at the time you borrow the loan. For federal direct unsubsidized loans are available to undergraduate students who demonstrate financial need. Federal direct subsidized loans are available to undergraduate students who demonstrate financial need. The Department of Education pays the interest on subsidized loans while a student is enrolled at least half-time and during the grace period. Your school will determine how much you're eligible to borrow. For federal direct unsubsidized loans, these loans are available to undergraduate, graduate, and professional students. There's no requirement for financial need for an unsubsidized loan. The eligibility amount is determined by your school based on your cost of attendance and other financial aid. The student is responsible for the interest that accrues from the date of disbursement, but the loan will be deferred while the student is enrolled and during the grace period, so no minimum payment is required during deferment. Borrowers can still pay interest during this time if they wish to do so, and that will help to reduce the amount of interest accrual on the loan. Again, the FAFSA is required since this is a student loan, a federal student loan. Next slide, please. So now we have Federal Plus and Grad Plus loans. These are the two direct plus loans available from the federal government. The Parent Plus loan is available to the parents of dependent undergraduate students. The Graduate Plus loan is available to graduate and professional students. A credit check is required for all plus loans. Borrowers must not have an adverse credit history to borrow a plus loan. If borrowers do have an adverse credit history, they may still be able to borrow a plus loan if they meet additional requirements. The maximum amount of this loan is your school's determined cost of attendance plus any other financial aid you're receiving. And the interest rates for this loan depend on what the rate is when your loan is dispersed. Again, FAFSA is required in order to borrow a plus loan. So if a student is borrowing and a parent is taking the loan out, the student would need to complete the FAFSA. Same for the graduate student. The Parent Plus loan will enter repayment immediately, but with that said, there are deferment options available to parents. The Graduate Plus loan has a 6-month grace period after graduation or separation before payments are required. Next slide, please. Private student loans. Private loans are non-federal loans that can be used to pay for the cost of college. They come from a lender such as a bank, credit union, state agency, or school instead of the federal government. These loans can help to cover the gap between your cost of attendance and any financial aid you are receiving after you've explored scholarships, grants, and federal loans. The terms and conditions are set by the specific lender. So if you're borrowing a private loan, it's important to ensure you understand the terms of your loan and that you keep in touch with your lender about any questions you may have. These types of loans often require established credit or a credit-worthy cosigner. So if you're an undergraduate applying for a private student loan, you more than likely will need a cosigner if you have an established credit and so on. Options are available for private loans for undergraduate, graduate, and professional students. Products vary by lender, and not all private student loans are the same. So interest rates, repayment options, and other terms can vary. Some can offer fixed and variable interest rates. Others can offer different types of repayment options and so on. So be sure to do your research fully and to read your disclosures to ensure you understand how your loan works. FAFSA is not required for private student loans, but it is encouraged to ensure you are receiving other aid that you may be eligible for that you wouldn't know you're eligible for without submitting a FAFSA, such as grants, scholarships, and work study eligibility. Next slide, please. So more details and resources regarding each loan type are available at studentaid.gov. When you visit this site, you'll be able to see the specifics related to loan eligibility amounts and limits, interest rates, and the terms of each loan. There are a number of other resources available on the site, so I would encourage you to review the information to ensure you have the best understanding of how your loans work. You can also use this site to review your current federal student loans and servicer information by logging in. The link for studentaid.gov will be available in the chat. It's also a really good idea to review your credit regularly. By visiting annualcreditreport.com, you can receive a free weekly copy of your credit report from each of the 3 credit bureaus. It's also a great option to view all of your student loans in one place, as private student loans would not show up in studentaid.gov because they are not a federal loan. So use this site to review your credit score and ensure you are staying on top of your finances. Next slide. And I will turn it over to Mel now for the step 2.
Awesome. Thank you, Raf. Again, my name is Melanie Martinez. I also go by Mel, and I am the Loan Servicing and Support Supervisor at HUACU. And I'm going to go over the second step, regarding federal repayment options. So if you can go to the next slide, Jen. All right. So knowing your repayment options is key, especially with federal student loans, since they offer a variety of options once you officially enter repayment on your loan. So we'll start with the fixed payment repayment plans, which include the standard repayment plan, the graduated repayment plan, and the extended repayment plan. These plans base your monthly payment amount on how much you owe, your interest rate, and a fixed repayment time period. When you leave school, you are automatically enrolled in the standard repayment plan, which has you pay a fixed monthly payment amount that ensures your loans are paid off within 10 years. The graduated repayment plan starts you off with a lower payment amount that gradually increases, typically every 2 years, and is also calculated to ensure that the balance is paid off within that 10-year period. Now, under the extended repayment plan, payments can be fixed or graduated, but are calculated to pay the loan off within 25 years versus 10 years. And another detail to highlight about the extended repayment plan is that you must have more than $30,000 in outstanding direct or FFEL program loans in order to be eligible. These options are not available for private student loans, so these are options that you will only find for your federal student loans. And if you want to be placed on any of these options, you can contact your loan servicer directly. And these options can typically be requested and processed by a representative right over the phone. Now, federal student loans also have several income-driven repayment plans available. We won't go into the individual details of all of them right now, but I'll highlight the facts that apply to all of the income-driven repayment plans. So as suggested by the name itself, income-driven repayment plans base your monthly payment amount on how much money you make and your family size. The Department of Education offers 4 IDR plans, which includes the income-based repayment plan, or IBR, pay as you earn or pay, saving on a valuable education, or SAVE, and this is actually the newest option under the IDR umbrella. And then lastly, the income contingent repayment plan, or ICR. After satisfying a certain number of months of qualifying payments under one of the IDR repayment plans, you can get the remaining balance of your loans forgiven. And because payments are based on your income and family size, you must provide your loan servicer with updated income, and family size information each year so that your servicer can recalculate your payment. This process is called recertification. And so you must recertify your plan even if there has been no change in your income or family size. However, if you agree to the secure disclosure of your tax information, the Department of Education and your loan servicer will automatically recertify your enrollment in IDR and adjust your monthly payment amount once a year. You'll also be notified when your payment is changing under these IDR plans, and you'll always be able to recertify your plan manually if you prefer to do it that way. Now, to get the full details on each of these options, like what percentage of your discretionary income is used to calculate your payments, visit studentaid.gov, where you can also submit your application if you're eligible. The income sensitive repayment plan is also listed on this slide. However, despite the name of the plan, it does not fall under the IDR umbrella. So some things to keep in mind is that the monthly payments can increase or decrease under this plan, ISR, and are made for a maximum period of 10 years, unlike the 20 to 25 years under the IDR repayment plans. There's also no forgiveness attached to the income sensitive repayment plan. So if the loan is not paid off within the 10-year period, you are still responsible for the remaining balance. And then lastly, only FFEL loans are eligible for this option. So you will not find this as an option if you have direct federal student loans. And the last thing I wanted to mention regarding this slide is that if you do have Perkins loans, please keep in mind that the repayment options are not the same as those with direct or FFEL program loans, even though Perkins loans fall under the federal loan program. Instead, you should check with your school or your school or the servicer for more information on Perkins loan repayment plans if you do have Perkins loans.
Mel, we have a question. Is it better to pay the interest on an IDR student loan repayment?
Is it better to pay the interest?
Yeah, is it better to pay the interest during the, I'm not sure, Kimberly, if that meant while you're in school or, you know,
If that is the question regarding like paying the interest while you're in school, then yes, definitely. If you are able to afford to make payments while you're in school towards the interest accrual, we definitely would recommend that because you will end up saving money in the long run on that interest accrual. Any unpaid interest that accrues while you're in school will be capitalized or added on to the overall balance of your loan once you do enter repayment on the loan. So yes, if you are able to make payments towards that interest, it will save you money in the long run.
and Kimberly, if you want to clarify it all, we'll get to some questions at the end too. So you could add a new question in the chat.
And we can move to the next slide. Perfect. So deferment and forbearance. These are options that you can use if you're experiencing a short-term financial bind. So if eligible, these options allow you to temporarily suspend your payments or in some cases reduce them. Reasons such as economic hardship, unemployment, or serving in the military are just a few examples of why you may apply for a deferment or forbearance. And something to keep in mind is that in most cases, interest will continue to accrue during your deferment or forbearance period. So this means your balance will increase and you'll pay more over the life of your loan. So these are really options that we recommend only when you truly need to use them. And the difference between deferment and forbearance has to do with interest accrual. So with federal student loans, interest doesn't accrue on some types of loans during the deferment period. So for example, if you have subsidized federal student loans, during the deferment period, you will not accrue interest on your subsidized loans. However, they will accrue on any unsubsidized loans that you have. And the same thing with forbearances. If forbearances, it doesn't matter the loan type. If they're subsidized or unsubsidized, the interest will still continue to accrue during any forbearance period. And that's with federal student loans. With private student loans, interest will typically accrue during both a deferment or forbearance period. So there is no subsidy attached to private student loans. They essentially work in the same way. Um, and another thing to note is that not all private student loans will offer forbearance or deferment options. And they are typically limited in comparison to federal student loans. So if they do offer deferment forbearance, you won't see as many options as you see for your federal student loans typically. And also keep in mind that there are usually eligibility requirements for deferment and forbearance, and you will generally have to submit documentation to your servicer or lender in order to qualify. And then lastly, you may be able to apply for certain deferment or forbearance options on your servicer's or lender's website, but you should call in and discuss your options if you're ever unsure or unclear on what's needed in order for you to move forward with either option. Slide. Right. So what happens if you miss a payment? I'm sure you can assume that if you miss a payment, there are, of course, consequences that follow, just like most of our financial obligations. So one of them being that your credit can be negatively impacted. So you'll be reported to the credit bureaus, typically once you're at least 30 days past due. And then that, of course, will impact your overall credit score, which can, of course, lead to other issues with any other financial obligations or goals that you may have. Becoming too far past due can then lead to default. With federal student loans, you typically reach default status once you're at least 9 months past due on your loan. And that typically means that your loan is then assigned to a collection agency, which then comes with additional fees as a result of collection costs. And default can also prevent you from borrowing additional loans, both federal and private. And the government can also garnish wages to pay off your defaulted federal student loans. So ultimately, you can end up significantly increasing the overall amount you have to repay by missing payments, basically. And so to avoid default and delinquency overall, we encourage you to open all mail related to your student loans just so that you're not missing any important details. Set up automatic payments if you're able to. That's going to help you stay on track, and oftentimes comes with a discount attached to automatic payments, which will help you save money on interest accrual. And then lastly, reach out to your servicer if you're facing challenges that impact your ability to pay, because there is likely an option in place that can help you get back on track, such as the deferment and forbearance options I mentioned earlier. Next slide. Right, and now we're going to get into some forgiveness and discharge options. As you all may know, in certain situations, you can have your federal student loans forgiven, canceled, or discharged, which ultimately all mean the same thing, which is that you won't have to pay back some or all of your loans if you are approved for any of these options. In addition to the ones you see listed on this slide, next slide, I'm sorry. Right. So in addition to some of the options you see here on the slide, which are a lot, oops, sorry, 1 second.
I did add the ones that you mentioned. Sorry.
Okay, perfect.
So I think this is a complete list now.
All right, awesome. So you do see the bankruptcy, discharge, the false certification. There's a lot of options for federal student loans when it comes to discharge and forgiveness options. And of course, the public service loan forgiveness, which is the most common way people apply to have their student loans forgiven. So that's the option we're going to highlight today. So let's get into it on the next slide. So public service loan forgiveness is a federal program designed to encourage students to enter low-paying careers like firefighting, teaching, some government positions, and so on. And there are a number of qualifying factors for PSLF that I'll highlight. First off, you must be employed by a U.S. federal, state, local, or tribal government or qualifying not-for-profit organization. It's important to keep in mind that qualifying employment for PSLF isn't about the specific job that you do for your employer. It's about who you work for. You must also work full-time for that agency or organization, which means a weekly average of at least 30 hours. And you must also have direct loans. So FFEL and Perkins loans by themselves are not eligible for PSLF. However, they can become eligible if you consolidate them into a direct consolidation loan. You also have to repay your loans under an income-driven repayment plan. So one of the IDR plans I went over previously, or a 10-year standard repayment plan, and make a total of 120 qualifying monthly payments that do not need to be consecutive. So if you have a period of employment with a non-qualifying employer, you will not lose the payment counts for prior qualifying payments you made under a qualifying employer. Another thing to note is that payments made during the COVID-19 pause will count towards the PSLF, as long as you meet all other qualifications. So if you were making payments during the time that you weren't required to during the pandemic, those payments will count towards that total 120 eligible payments. The Department of Education did create the PSLF help tool that allows you to search for a qualifying employer. And you can also learn what actions you may need to take to become eligible for PSLF, and generate a PSLF form right from that tool as well. So if you think you may be eligible for PSLF, please use the help tool to confirm that your employer qualifies, and to also submit the form. It's a really easy process using that tool. MOHELA is the servicer that currently oversees public service loan forgiveness for the Department of Education. So they are responsible for reviewing and processing any of the certification forms that are submitted. So if MOHELA doesn't already service your federal student loans, your loans will be transferred to them once the form is processed. And once you reach that 120 qualifying payments, MOHELA will confirm your eligibility and forgive the remaining balance of your loans at that point. You can also find out how many qualifying payments you've made by logging into your account with MOHELA and viewing your loan details, or by looking on your most recent billing statement. I also want to highlight the temporary changes that were made to PSLF as a result of the pandemic. So basically, the Department of Education is temporarily bending the rules on which payments count towards forgiveness under PSLF. If some or all of the payments you made on your direct loan program loans were under a non-qualifying repayment plan for public service loan forgiveness, you may still be able to receive loan forgiveness under the temporary expanded public service loan forgiveness option put in place by the Department of Education. The additional qualifying payments under this expanded option includes graduated repayment plan, the extended repayment plan, consolidation standard repayment plan, and consolidation graduated repayment plan. These plans don't usually qualify for PSLF, but will qualify under the expanded option in place. Your payments will automatically be considered for PSLF and PSLF after submitting the form to MOHELA. And like the standard PSLF, only direct loans are eligible for this temporary expansion. So if you had a FFEL program loan, you would have had to consolidate those loans before the end of 2023 in order for them to be eligible for the temporary expansion. So if you consolidated your loans at the top of this year, you can still be eligible for a PSLF as it is on its own. However, you just wouldn't be eligible for the temporary expansion of the PSLF program. There are a number of qualifying details that I'm not able to cover in this session, unfortunately. So you'll want to review them before moving forward with this option. And I highly encourage you again to visit studentaid.gov because they will have the most up-to-date and accurate information regarding PSLF. And also, again, use the help tool to help guide you along the way and help you cover your bases. And you can also contact Mohila directly with any PSLF questions that you may have. The last thing I will mention regarding forgiveness and discharge is that these options do not apply to private student loans, such as any education loans you may have with HUECU. So private lenders may discharge a loan due to the death of the primary borrower, but that is typically the extent of the discharge and forgiveness options you'll see with private lenders. If you are interested in finding out what your options are and you do have private student loans, you want to contact your lender or servicer directly. And just keep in mind that the options are going to vary from lender to lender. And you can go to the next slide. Oh, actually, you can go to the next slide. We cover studentaid.gov too. And I will hand it back off to Rafaela.
Thank you, Mel. All right, so considering refinancing, whether your loan is just entering repayment or you've been making payments for quite some time, it may be a good idea to research refinancing your student loans to see if this option might be right for you. Next, we'll cover the reasons you may want to consider refinancing, how it works, and how refinancing could potentially help you reach your financial goals. Next slide, please. So what is refinancing? A refinance loan is a new loan that combines multiple private and or federal loans into a new loan with one interest rate and one payment. Refinancing may be beneficial for those who are looking for more favorable borrowing terms, which could be a lower monthly payment, lower interest rate, or those who are looking to pay all of their student loans in one bill. Some borrowers may consider refinancing their loans if they learn they're eligible for an interest rate that's lower than the rate they have on their current loans or on multiple current loans. Borrowers may also consider refinancing if they have a variable interest rate and are looking for more stability with a fixed rate. Refinancing could also make sense if a borrower is looking to extend their term to reduce their monthly payment, although it's important to be aware that this may increase the total cost of the loan. Since you're paying it over more time, there's more interest that would typically accrue. There are typically no prepayment penalties on refinance loans, so they can be paid off early without any sort of fine or penalty. Be sure to check with your lender to confirm the terms and conditions of your specific loan. Finally, it's important to understand that federal consolidation is different from private refinancing. Federal consolidation allows borrowers to consolidate one or more federal education loans into a new direct consolidation loan for the purpose of lowering your monthly payment amount or gaining access to federal income-driven repayment options or forgiveness programs. Next slide, please. So what should you consider before refinancing? Well, some things to consider when refinancing definitely include the interest rate. You'll want to review your current rate and the potential rate you'd receive by refinancing. Interest rates are typically based on your credit file, prior credit history, and so on. And lenders often allow you to receive a rate estimate before applying as part of the pre-qualification process. If the interest rate is lower than your current rate, or if you're looking to switch from a variable rate to a more stable fixed rate, refinancing could possibly make sense for you. Choosing a longer repayment term may result in a lower payment, but again, may cause you to pay more over the life of the loan. Choosing a shorter term may result in a lower rate, but a higher monthly payment. So it all depends on what you're really looking for. It's important to consider the benefits you may be losing by refinancing, however. For example, for federal loans, you will lose benefits such as interest or payment waivers, potential loan forgiveness, flexible federal repayment loan options, and federal loan discharge options. So it's really important that you do your research before refinancing to make sure you're understanding that you are losing those benefits. It is important to note that you can choose to refinance some loans and not others. So if you're interested in just refinancing private loans, you can certainly do just that. Um, and you can just refinance, let's say you have all loans with the lender, refinance those with a lower rate and keep your federal loans if that's something you'd like to do. So you can pick and choose. Repayment on refinance loans typically begins immediately, with the first payment being due 30 days from the date of disbursement. It's important to ensure you continue making payments on loans you are refinancing until you've received confirmation that these loans have been paid in full. So when you do go through the refinance process, keep making your payments until you receive that paid in full confirmation from your other lenders. Next slide, please. So here we have a repayment chart. This chart is a great example of how refinancing can be beneficial. The current loan you see there has a higher interest rate at 8.5% and a remaining term of 103 months. You can see how the lower rate impacts the total cost of the loan, even with a longer repayment term. I think that's just the next two arrows. Yeah, perfect. So you can see here how the lower rate impacts the total cost of the loan, even with a longer repayment term in the new rate and term line. If you make the same payment on the new refinance loan, you'll be saving on the total cost and paying the loan off faster. And you can see the power of refinance by making an increased payment on the new loan, as shown in the last example. So you can see here how refinancing can lower your monthly payment and can also reduce the total cost of your loan, and then also reduce the amount of time it takes you to pay your loan off. And making an increased payment can have a huge impact on your loan, especially with a lower interest rate. So that's really important to consider if you're looking into refinancing. You could pay your loan off sooner and so on. So that can really help you reach your financial goals. That's something you're looking to do. Next slide, please. All right, Green Path. So as a benefit of your credit union membership, you have access to the Green Path Financial Wellness Program. Green Path offers free expert credit, housing, budget, and debt management counseling, and this includes federal student loan counseling. Our counselors will work with you to understand your specific financial situation and help develop a personalized plan that works for you. And there are a number of other resources available on the Green Path site, including free webinars and articles to help you increase your financial awareness. If you haven't looked into Green Path yet, I would strongly encourage you to do so. There are a lot of great resources there to help you reach your financial goals and become financially aware. The link will be available in the chat.
Rafaela, I also just want to mention that you do not need to be a member of the credit union to use our Green Path referral. You just, if you go through the link in the chat, you tell them that you were referred by us, they will provide the same services to you. So you can get those individual counseling services around your student loan repayment or any of the other services as well.
Thanks, Jen. And we can go to the next slide. Thank you. So now that we've covered the student loan basics, you have some work to do. First, you'll want to review the types of loans you have and how these loans work. After you have a good understanding of that, the next step would be to research your repayment and loan forgiveness options to ensure you understand which options are available to you. And finally, take a look at your current loans and do some research to determine if refinancing may be the right choice for you based on your current interest rates and payment amounts and so on. Next slide, please.
So thank you so much, Rafaela and Mel and Kimberly, for walking us through. That's a lot of content, and I know people are still answering some questions in the chat. Know that if you need individualized services, we do recommend you talk to someone at Green Path. And I'm going to put another link in the chat for an organization called TISLA, which will also do individual counseling for you around student loan repayment so that you can get your particular questions answered. But the question we would love answered is, how did we do? I am going to put the survey in the chat. It will also be emailed to you. We would appreciate your honest feedback about this webinar and any other services that we have. So please do go in and complete the survey for us. We would appreciate that very much. I think it's clear that we can't answer every question, and this is not meant to be legal or tax or investment advice. And again, we do recommend that you work with a personalized advisor. Again, GreenPath is one that we highly recommend for their individualized services around your debt and other financial goals that you have. And then one that is only about student loans is TISLA. I'm going to put that in the chat as well. So those are great resources for you that can provide you with individual advice. This is information, you'll get these slides by email also. So this is information about how to reach us. We do have branches at Longwood Medical area, as well as here in Harvard Square and around the area. We'd love to hear from you. And then finally, we do have a blog here at the credit union called Thrive, and through the Thrive's page on the Harvard Credit Union site, you can find lots of information about prior workshops, how to access that financial counseling. So that could be your hub for, lots of short videos about different topics that we've done in the past. So that can be a good place to check in if there's a financial question that you have and that you would like to have answered. Okay. So that said, I want to thank you all for coming. And panelists, are there any of the questions remaining in the chat that you want to take a stab at answering live? And if anybody else has any other questions they wanted to throw into the Q&A, thank you. I know that the EAP program at MGB is really great and important. I think we're answering them mostly in writing. Let's see. Okay. All right. So hang tight. We got an answer coming at least. Yeah, these are, complicated topics and really important for being able to achieve our educational goals or our children's, I'm in the middle of that myself as well. My daughter's in college at UMass Amherst, and all right. Okay. Thank you, everybody. That's going to wrap it up for today. And if we did not get to your question, we do recommend that you tap into one of the individualized services to provide you with advice, whether that be GreenPath or TISLA, and reach out to your lender as well, of course, and use the links that we provided in the chat for the studentaid.gov as well. And with all that information, you're going to be much more empowered to be able to make the right decisions. Thank you.
Thank you.